Hello and welcome to this video on DuPont analysis. The return on equity ratio, ROE, is equal to net profit divided by average equity is one of the most commonly used profitability ratios. ROE is a very important profitability ratio because it provides a summary measure of business performance. However, ROE can be influenced by both a business's operations, that is, how well you're selling your products and how profitably you're selling your products, and also the financing decisions you make, how much debt you use compared to your equity levels. So to improve upon our ROE measure, we're going to introduce the concept of DuPont analysis. DuPont analysis is still a way of calculating the return on equity, but instead of using net profit divided by average equity, we're going to break down the return on equity into three subcomponents. DuPont analysis allows us to gain a better insight into how the business has generated its return on equity. The three subcomponents that help us generate our ROE are the firm's profit margin, the firm's asset turnover, and their capital structure. So when we use DuPont analysis, we break down the return on equity formula into these three components. First of all, net profit divided by sales revenue. That is the same as the profit margin ratio. Next, we multiply the profit margin by sales revenue divided by average total assets. That's the same formula as the asset turnover ratio. Finally, we multiply by the average total assets divided by average equity. This provides us a measure of the leverage used by the firm during the year. If we do a little bit of algebra, we can see that this DuPont analysis is the same as our original ROE formula, that is, net profit divided by equity, but we've introduced some new terms to see what drives the ROE. So first of all, we can cross out the sales revenue here and here, and net profit over average total assets will give us our return on assets. So what we can learn from this is the firm's profit margin multiplied by its asset turnover gives us its return on assets. So now we can understand what is driving the firm's return on assets. Is it because they've got a high profit margin, or is it because they've got a high asset turnover? Finally, we can cross out the average total assets and we're left with net profit over average equity. So return on equity equals net profit over average equity, the same as our original formula. However, when we keep it as part of these three components, profit margin, asset turnover, and leverage, we can start to understand what is driving the firm's return on equity. Using DuPont analysis is really important because it allows us to consider the business's strategy. Whenever we do ratio analysis, we want to consider what is actually happening in the business's real life operations. So we don't want to just get stuck in the numbers, we want to consider what's actually happening with the business. And the strategy of a business can broadly be brought down into these two concepts. There are businesses that are cost leaders and there are businesses that are differentiators. Firms that follow the cost leadership approach generally have a very low profit margin and a very high asset turnover. Think about your supermarkets. Here we've also got the example of Dell PCs and Toyota. They're both cost leaders. They sell their products for a cheaper price, but they sell lots of their products to make a profit. Differentiated products, we've got a nice photo of a Ferrari here. Apple is also a differentiated product. They've got a very high profit margin compared to Dell. And Ferrari are a differentiated product compared to Toyota. They have much higher profit margins, but much lower asset and inventory turnover. If we look across different industries, we'll see firms will have different profit margins and different asset turnovers depending on the industry. So when you're analyzing a firm and you look at their return on equity, you want to break it down into its subcomponents. And then when you look at the profit margin and asset turnover ratio, you want to understand how's your firm comparing to other competitors in the industry, and realize that different industries will have different benchmarks. If we graph this, we can see that profit margins and ATOs, each of these little dots here is an industry grouping. We can see that different industries follow different patterns. Some industries have very high turnover and low profit margins over here, while other industries may focus more on the differentiated product, have high profit margins and low turnover. And then some industries will have firms operating in both sections and they will average out somewhere in the middle. So to conclude, DuPont analysis is a breakdown of the return on equity formula, and it's important to do because it allows us to gain a better understanding of how a firm has generated its return on equity. We know the return on equity is driven by the profit margin, their asset turnover, and how successfully a firm uses debt. If you borrow a lot of money, if you're generating a return on assets that is higher than the interest rate you're paying on your debt, it's going to lever up your return on equity. That is, the debt you're using will increase returns for equity holders. However, if your return on assets is less than the interest rate you're paying on your debt, the leverage that you're using will rapidly decrease the return on equity. That is, using leverage increases the business's risk. It magnifies your returns if you're using it successfully, but it also magnifies any losses if you're not using the debt to fund profitable assets. So understanding how the business is generating its return on equity is really important for analysis, especially when you start thinking about forecasting, because how a business is able to maintain its profit margin is heavily dependent on the industry it's in and the level of competition. And the asset turnover, likewise, the industry and competition will have a big focus on how the ATO is generated.